Well, welcome to our Short Verticals class today, everyone. I'm Connie Hill. We get together every day, or every Thursday, I should say, at this time, and take a look at short verticals, because I know short verticals can be a bread and butter strategy for a lot of traders. Now, I'm going to show you something. This might be a little embarrassing, but I'm going to show you my mostly empty tube of toothpaste, okay? Want you to think maybe what it might have anything to do with short verticals. Okay, I'm going to leave you on the chain for just a moment. Now, I hope you're following us on X. I'm Connie Hill, CS. We have Brent Moores in the chat. I'm happy Brent's here. He's a good friend, fellow coach, great veteran of the markets. He is Brent Moores, CS, and we'll post educational content throughout the day, just depending on what we see that might be coming up. If you follow us, it's free, it's easy to do, and you'll get those little nuggets along the way. Now, let's go ahead through our disclosures and let's lay out our agenda here for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for educational and informational purposes only. Don't consider it a recommendation of any sort. We will be using the downloaded software application of thinkorswim, right? That's the most robust version and is great to practice in and to learn new strategies. Having that paper money side is so useful and helpful. Investing involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. That's an important concept for our class, because every single trade we do, there's a short option there. Paper money does not mimic early assignment. And that's one thing you need to know that's different from paper money than from a regular account. A regular account definitely can assign early, which basically means before the option's expiration. Past performance of any security or strategy does not guarantee future results or success. Now, if you think you have any idea of why I held up my mostly empty tube of toothpaste, I want you to chat it in here. I know people are just kind of getting up and joining us here. Some workshops coming up, and Market Drive Events Anaheim is going to be May 30th, 31st. That's a 2-day event for advanced options. Those of you that maybe have been trading some basic option strategies and feel like, hey, I'm ready for some of those multi-leg strategies, you'll be interested in that workshop. Miami and New York are Market Drive events, which are just one day. It's a little bit more geared to what's going on in the market right now, what things might people be noticing, what things might be relevant that would help you in your trading. Okay, so totally different focuses. We always want to talk a little bit about short verticals. Now, this is an intermediate level class, so you probably should have some idea what that is coming into it. But even if you're new, I want you to be able to follow along, pick up what you can, even though maybe you haven't totally been exposed to the strategy yet. Today, we're going to take a little bit of emphasis in talking about trade techniques, monitoring techniques, as well as exit strategies. And of course, we're always going to do some examples, and we'll do that frequently. All right, let's just talk about benefits and risks of short verticals, because for every strategy, there typically are some virtues. What does it do well? And then there typically are, some things that might be negative that you have to be aware that it's a reality in that kind of a trade. So benefits, short verticals generally is used to create an income stream in people's portfolios. Depending on which strike price or deltas are selected, it could become a higher probability trade. It could become a lower probability trade, just depending on how you're comfortable structuring it. Your gains are capped. Okay, they only go to the credit we receive upfront when we put on that credit spread. Okay, it's not going to get any higher unless you do something exiting the legs separately. Okay, but upfront, that's your max credit. It's not going any higher. And generally, people, when they're writing these types of contracts, they are a short time frame, sometimes maybe a little bit of an intermediate frame. Most of the time, we're going to work with between 20 to 40 days worth of time that we're selling in those spreads. Now, what are the risks? And maybe you've experienced some of these risks, okay? The difference between your two strike prices minus the credit received to enter the trade is your potential max risk, okay? many times, depending on how the trade is structured, but many times a high probability trade, the probability or the loss that you might incur from the trade going against you, many times is going to be greater than our actual credit that we're bringing in. Sometimes people have a hard time initially kind of dealing with that. They're like, why would I risk more than what I could make? And the reason you might is because of that probability, which we know they're theoretical in nature, but it's nice to have an idea of how likely could this trade work out for me. You know, there's always a transaction fee when we do this. In case of spreads, typically, there's going to be 2 legs on it. So we're going to have 2 initial fees for each, well, one fee for each leg getting in and getting out. All right. Carrying option positions into expiration entails additional risks. And so we'll talk a lot about getting out of trades early, not holding them to options expiration date. Now, I want to go back and see if any of you had an idea why I might have shown you my almost empty toothpaste container. Now, somebody's very smart here. Dean, you wrote in decay. Teeth decay, our trades decay. I love that. I didn't even think of that, Dean. That is perfect. Kevin says your max gain out of pocket, that YouTube hopefully before it reaches its expiration date. I think we're talking about assignments there. All right. Some of you just don't even have any idea what that tube of toothpaste is about. That's okay. I'll tell you here in just a moment. All right. Want to focus a lot today on exiting these trades. Sometimes we're really good at where's our entry, what are we looking for, getting the trade on, and maybe not as much time on the trade management aspect. So we're going to focus on this a little bit more heavily here today. So number 1, exit 4 to 10 days before options expire. Okay. How many of you that are trading those verticals use that rule? You try to get out 4 to 10 days before options expiration. Quite honestly, you don't have to get out of the trade, right? Because the trade could expire completely worthless and you wouldn't have to go and pay a commission to close the trade out. But is that the best way to trade it? Maybe not, okay? We'll talk about that a little bit more. Sometimes people say, you know, and we've done this a lot in our class, if we can get a percentage of the max gain, we're going to be happy, we're going to take it, we're going to get out, which is where the tube of toothpaste comes in. We do not have to get every little teeny speck of toothpaste out of the container or every penny out of the spread in order for it to be a great useful spread to our portfolio in terms of generating some cash. Now, we may need to get out if there's a predetermined exit. Maybe you decide, hey, technically, if the stock does this, it's not working out for us and we better get out. Or if a stock breaks a resistance level or support level in case of the short verticals, which we'll focus on here today, if it breaks a major support level of that stock, sometimes that could be a sign to say, things are changing and maybe the trend is changing and we may need to take some action, some defensive action. Okay. Ed Never Eat Care says, I'm stumped on the toothpaste. Yes, Wayne, trying to squeeze the last little bit out of the tube or a short vertical. Perfect. Now, Wayne, you nailed it. Yeah, that's what it has to do with it. And I have used that analogy quite a bit. We're going to keep using that idea. And maybe when you go to sleep tonight and you have your sweet dreams about verticals, this little tube of toothpaste will come floating into your dream, and then you're going to remember. Now, why is that a big deal? Okay. The reason that is a big deal, these getting out when you make a percentage, getting out before the options actually expire. If you've ever had a position go against you, maybe the day before expiration, you're thinking, I got this in the bag. This is sweet. I don't need to go buy that back. And then the stock comes out with some sort of news that takes you from a max gain to a max loss. And it was on the day the option expired with no room for that stock to recover because you held on to the very last minute. How many times do you have to have that happen to you before you think, maybe I want to be like the tube of toothpaste. Maybe I don't want to hold on so long. I want to grab a chunk and move on. Okay. It comes from experience. Okay. Some of you may have experienced that as well, but you're not needed to confess here. Okay. let's head on over to Thinkorswim. And let's just take a quick look at the markets. Are we in a little bit more bullish, a little bit more bearish of a position? The SPX, which we'll start out with here, I've got a 10-day moving average is the blue line, and the red one is a 30-period moving average. More often than not with short verticals, we're looking for those shorter time frames, right? We're not looking for a big old trend trade, although you could create a spread with that with a lot of time if you wanted to. What we've got going on here with SPX, it's interesting, ran up, kind of pulled back. This had been an old area of support / resistance. It looks like that's about, trying to read that number, kind of 5,800-ish, okay? And the last couple of days, it's kind of been hanging around. It's like yesterday, it dipped through it and closed below it, but we know support and resistance are areas, and today, maybe it's taken a bounce, right? It's a little bounce at this point. Earlier in the day, we were down. Looks like the SPX is up right now. We'll see if it continues that way as the afternoon progresses, okay? How about the VIX? VIX, hopefully you're like, oh, I look at VIX all the time. I look at it every day. I know where the VIX is at. Is that the case for you? Okay. VIX is in a relatively low area. Is that the lowest it could go? No. The lowest it could go, and that we've seen in previous years, has been down, I think, maybe around 8 point something, maybe 9 point something. And this was a long time ago. If we look at the volatility index, let's just go a couple of years here. For the last couple of years, maybe the lows have been around here. This is about 1245. I think once we poke down here to 1152. So more recently, that's where our lows have been. And certainly where it's sitting right now, about what, 19? It definitely is off these astronomical highs when people were scared and fear ramped up the scale real quickly. Definitely down in a zone where it's saying, okay, not as much volatility, not as much fear in the marketplace. I think possibly a good part of that, why that's the case, is what was announced over the weekend with the tariffs, that the Chinese tariffs and the tariffs against Americans from the Chinese, we're going to have a 90-day hiatus and see if they can work something out. That's really actually helped the market quite a bit. Yeah, I'd Never Eat here says, keep going down, VIX. Yeah, keep going down. All right. I'd Never Eat here. This is, I have to recognize your comment. 9 out of 10 dentists recommend using option spreads versus single leg options. You know, if you do some experimentation, you might come up with some of those strategies on your own. I don't know if it's going to be a 9 out of 10, but it's a good thing to certainly discuss. All right. I want to start out with our trades we put on last week. Guess what? They're all doing great. Okay. We're going to come up here to the monitor tab. We have 3 trades in our short vertical section of bulls. We don't have anything in our bears right now. And all these trades we put on last week. Got them open up so you can see what's in here. We each of them have 29 days before they expire. So we've got, what, a good 4 weeks out there before they'll expire. And all of them, at least initially, yeah, this one's up about 17%. Our PM trade's up about 58%. Our CrowdStrike, it's up about 21%. So they're all a little bit profitable. Let's just take a quick look at the charts. Okay, on CrowdStrike. I marked where we got into the trade. You can see that green oval. Maybe I'll collapse this down maybe to about 3 months while we look at our stocks here. We got in here, getting in on what we thought was a bounce off this diagonal support. And the stock's kind of meandered up that way. It's taking a nice bounce today. I've drawn where our short leg is here. Our short leg is at $400. So we need this stock to stay above $400. So far, it's doing pretty great. You know, from this point in the trade, what could possibly happen is, you know, it could just sit here and go sideways for a while. It could go up a little bit. That would help us lock in our gains early and help us get out of the trade early. If it would do that, cooperate that way. But even where it is sitting right today, it can still go down quite a bit and would still possibly be okay in the trade. 446, we've got a $46 leeway on CrowdStrike. Now, it is a more volatile stock. It is a higher price stock. That means probably it makes some bigger moves than maybe some other stocks, okay? But $46 leeway kind of feels good here. That's about with the price of the stock right now, that's about a 10% leeway, okay? So what are we gonna do? We're gonna let it work. We're gonna be patient. We have our order to get out of there when we get a chunk of the gain. And I think I was, last week, a lot of them we did 70%. I think there was a couple we did at like 65%. And so we've got working orders sitting out there to buy it back, okay? Philip Morris, same thing. We've got, let's just pull up its ticker symbol here real quick. We got in on the big green oval day, and it's just continued to move. This is the one that's performed the best for us so far. And right here at 165 is its short leg. How much leeway does it have right now? It has about $10, right? It could go straight. It could pull back up to $10. It might even drop below 165 and still could be just fine. Last week, we talked about the probability of touching, and that, you know, sometimes there's a high probability a strike price might go to a range, but not necessarily expire there. Hopefully going through that discussion has helped some of you when maybe a trade you're doing maybe initially doesn't go exactly the way you thought it would, but you look at the probability of it actually touching, you're like, oh, well, it was more than the probability of it actually expiring there. So we know there's a good chance it's going to touch it. I hope that discussion was helpful to you. Bob wants to know what was the net credit on our CrowdStrike short put vertical. Let's take a look here. On CrowdStrike, you know what? It didn't do the math on this one. I do not know why. It didn't do my math here either. I had to actually use a calculator here. I like it when it does the math for us. Not sure why those didn't calculate. But basically, let's just run the math here. Oh, it did. It's 126. I take that back. I was thinking it said 0. I was looking at this 0 line. We got $1.26 on it. Okay. It's a $5 wide spread. So our maximum gain was 126 per contracts. We did 4. And what do we have at risk? That looks like about 374. $5 minus the 126. Okay. So that's where that was. I actually don't necessarily need to have this beta weighted for our conversation. So I'm just going to actually take that off so it's not a distraction. All right, we've got CrowdStrike. We did Philip Morris. The last one here is Walmart. And really Walmart, our short leg here is 95 on Walmart. All right, we identified the day we got in. Has it been perfect for us? Well, it ran up really nicely. It was a green candle for 3 days. The last, say, couple of days here, it's pulled back a little bit, but it hasn't even come down to our strike price of 95. Okay, would love for it to stay above there the whole time. But even if it does go a little bit lower, it's okay. If I come over here to the trade tab and we look at our Walmart position, okay, I want you to know this is our probability of touching column. This is our probability of the option expiring out of the money. If I come down here and we look at our short leg here, which is this one right here, maybe I marked that wrong. Yeah, I wonder if I marked that wrong, 95. Oh, I marked the right one. I was thinking I marked 92.50 and that it wasn't right. The 95, the probability that it still could go and touch, it's about 79%. Okay, so almost an 8 out of 10 chance it'll do it, 4 out of 5 if we boil that number down as well. And right now it's sitting at about 60% that it's likely to expire out of the money, but we've got plenty of time. We're just going to let these guys work. Okay. Now the one, I'm going to go back to our slides here on the exit signals that we wanted to focus on here today. Okay. Right now, the only one we focused on is getting that percentage of a max gain. Okay. That's the only one we really have needed to use. But if the trade does go against us, we might have to rely on one of these others. Could you put those in as hard stops? You certainly could. Okay, and some people do. Some people don't because they say, well, it's a hedge position anyway. It was put on as a higher probability trade. Therefore, I don't want to hard code the exit in there. Okay. The other thing is if you hard code the exit, you don't have the possibility of trying to change up the trade. We've talked in the past about, trying to salvage a trade that maybe has gone against us, and where we've had to buy back the short leg and we kept our long leg with the intent that maybe we were expecting it to make a big move and make up for our loss. If we put in a hard stop at maybe one of these levels, that kind of eliminates that possibility for us. So that's another reason some traders don't like to do it. All right. Let's take a look here. Oh, let's see. Brent's let me know something. Bob was asking about CrowdStrike, not PM. Oh, what was the net credit on? I think we answered both with this being open. I think we noticed what all of the credits were. So PM is 126. And I'm sorry, I pointed to the wrong one, didn't I? And this one, it was 275 credit, and it's a $10 widespread. Okay, so 275, that's our max theoretical gain on a couple of contracts. So, in the neighborhood of about what, 550, something like that. If it were to go all the way to expiration, we kept every little last penny versus going out if we get a chunk of it. Okay, it's making good progress. Now it's down to 215. We've been in the trade for a week. We're up 20%. Sweet, we're happy. It's doing exactly what we would want it to do. And we got to be patient and just let time decay. Let's go back to our charts here. How many of you were here for our discussion last week about probability of touching? If you were, go ahead and chat in the chat to me, okay? I'm curious to know who was here and if you thought about it this week. One thing when we maybe emphasize something in one of our lessons, it's great if you can start practicing it immediately. That's how we retain information. It's how we develop in our strategy. It's how we fine-tune rules, is if we go, oh, well, maybe I ought to look at that. Maybe somebody wants to put in on their rules to just check what that probability of touching is and not necessarily make a trade-off of it, but maybe just noticing it, okay? If you missed that class, I'll put a link in the show notes from today, but I also, even more, hope that you've subscribed to our Trader Talks channel, right? Blue little YouTube button down in your bottom right-hand corner. You click on it once in your whole life, and then you're subscribed to the channel. If you click on it again a second time, it'll unsubscribe you, okay? But you should be able to see when you've subscribed, and then it'll show you some of our recent videos. You can go and pull up the playlist. You can go down and say, oh, I didn't know about probability of touching. Maybe you come out here to our short verticals playlist, which I think was about 7 down. Maybe it's only 6 down here. Yeah, short verticals. Don't panic when a stock hits the short strike. Okay, that's what that probability of touching was about. Chris says, that was a lot of risk for a $10 spread, though. It's actually, let's run the math. Okay, let's run the math, and we're going to look at some new opportunities. Oh, you were looking at the probability of touching, and maybe that was an off thing. Yeah. So on CrowdStrike, it's a $10 wide spread, and we brought in 275. Okay, so 725 is what we have at risk. Okay, so let's just divide that out. I can get my little calculator to cooperate here. Okay, let's go 275, our max gain, divide that by the max theoretical loss. That would be 25. It's about a 37% return. So when you run the numbers, some of you might go, oh, I like a 30-something. I'm happy with that. Okay. There might be others of it. If you say you like to get a 40% return, then it might not be enough for somebody that has those kind of guidelines of what they're looking for, okay? But for what we talked about in our class, where we're looking for maybe a high 20-something return, maybe something in the 30s, maybe something in the low 40s for a high probability trade, it fits in that ballpark. All right, let's take a look at some additional trades. Guess what? They're going to be all short put verticals. Okay, I'll spill the beans right now. Let's see. Vic was saying, can we see the chart on the full screen? Hi. I think you're asking here maybe to go back to CrowdStrike. I'll pull it up real quick and then we're moving on. Okay. Okay. Our managers are working that in. All right. So I think we're good here. All right. You're saying for me, maybe the dollar amount is a little high. Could be, right? Depends on what kind of an account you're working with. You're definitely going to want to position size it. Google. Here we come to Google. What's happened to it? Definitely it started higher highs, higher lows, right? Since it bottomed out. Earnings is back here. So earnings aren't on the horizon. We don't need to worry about it. What did it do today? Well, today, it broke through this area of resistance. Let's maybe show you a little bit more of where that might have been from. You can see it was kind of support here, resistance here, a nice support bounce back there. So it's been an area Google's gone to quite a few times. And yesterday we weren't quite sure if it really broke out, right? And today it has given it some nice follow through. Both days, today and yesterday, have some above average volume. When you see that, typically means institutions are in there as well, not just a bunch of retail traders, and institutions don't have a tendency to day trade. This was up higher today, and some might be a little bit concerned about what this candlestick today might mean. It could be a shooting star. A shooting star basically gaps up higher than the previous day's close on a bullish candle. It runs up some more, but then it pulls back as the day goes on. So it's kind of like the momentum kind of is fizzling out. There may be some people, when they see that candle, they say, oop, I'm going to pause. I'm not going to put on a trade until I get maybe some confirmation that it's not going to have a third candle here pulling back. Okay, that would be the confirmation of that shooting star. So in our case, we're actually going to ignore this. It did hit it at pure resistance, but you know, that support area, that 168.50 has been pretty strong. So for our circumstances, we're going to give it the opportunity to stay above there, right? We're going to see if it'll stay above 168.50. Well, as we come over here to the trade tab and we look at different options, some of these, I think especially these with 22 days left, there could have been some possibilities in there, but some of the strike prices, the way they lined up, were on the strikes that didn't have the oodles of open interest. Okay, they didn't have 5,000 contracts. They only had 233, or in this case, 464. Okay, versus the other legs really had quite a bit more. So we're going to go out here to the June 25s. I like how this lines up anyway. And on this one, we're going to go 170. Well, we were looking at going at 170, 167. Maybe we can even pull back a little bit more and still have oodles of open interest here. Let's go to our 34 delta instead of our 40. I think things have shifted enough that that might be a consideration. So let's go ahead. Let's sell that. And it's a $2.50 wide spread. I'm gonna lock it in here at 75 cents so we can work with those numbers, right? So $2.50. That means 2.5 minus 75 should be at risk $1.75. Okay, should we make sure my math is correct here? I think we should. All right, so there's $1.75. So then we say, okay, is that a good enough return? All right, so 5 divided by our max theoretical loss of 175, that's about 42%. So that's actually quite, I'm going to say juicy for this stock at this period of time, especially acknowledging it's a 30-something delta. Maybe somebody wants even a higher probability of expiring out of money. Maybe you would like it see it at 68 instead of 62. Okay. Yeah, then you might be able to slide a little bit more, and it doesn't really matter which direction you go. There's plenty of open interest on those contracts. Okay. Risking $1.75 in our class, we allow ourselves the opportunity to risk $1,500. Okay, so let's take our $1,500. We're going to divide that by our 175. And that says, hey, we do 8 contracts. So we're going to, okay, we're going to do all 8 contracts here. Let's change this to a first trigger sequential. We'll create here an opposite order, and we're going to go with that exit strategy of exiting when we get a percentage of the gain. Now, those of you that maybe trade this way and put in a percentage that you like to get as a gain, if you don't mind, would you mind sharing maybe a very common percentage that you like? Okay. I think people are going to be a little bit different here. Some people might want a bigger piece of the pie and be willing to maybe hold on a little bit longer. There might be some people that are like, oh, I'm willing to have a smaller chunk of the max gain and be content and happy to get out early there. Okay, so those of you that actually do that, I'm going to look here for in the chat window, see what your response is. You guys know in our class, many times I'll use 70%. 70% doesn't have to be the amount that you choose. You know, for a long time, I used 80%, but then I was finding we were getting profitable in some of our trades, but we weren't getting up there, and then we were losing some money, which is why I dropped it down to about 70. All right. Ron, Priva, 80% for both of you. John, Frankie, you're both about 50%. Vic looks for 30 to 35%. So you're saying, just give me a chunk of the pie, right? I don't need to have a whole bunch of the pie. We've got a 70 to 75%, 50 to 75%. So maybe a little bit in a range there. Rory's at 75. Oliver, 50 to 80. Okay. Thank you for responding back here. Like I said, some of you are going to have different numbers that maybe you are targeting. Okay. And Chris says, you know, maybe 50 to 70 to 5%, depending on your confidence level with that particular stock that you're working with. Sounds good. All right. Today, I'm going to write this number down so that when we're doing this next week, actually not, we're going to go for 65% here. That's kind of actually sort of in the middle of what some of you are doing, right? So let's target how much of this 75 cents? Let's target 65%. Okay, so we're going to plug in here our 75 times what? If we've got 65%, we've captured it, that means about 35% is left. Okay, so we're going to multiply that by 0.35. And so that says go buy it back at 26 cents. So that is what we're going to do. We're going to put that at 26 cents. We want that to be a limit order. We're not going to put another exit order on it. That's the only one we're going to use at this point. Now, we reserve the right to maybe put on other exit conditions, depending on what it's doing. Maybe a stock's getting in trouble. Yeah, we might consider maybe doing an OCO order, right? Leaving it at, buy it back at 26 cents, or get out if the stock does X, Y, or Z that we don't like, right? We can always add that. So we're going to go ahead. We're going to put this in our bullish short verticals bucket. All right. Let's see here. Artie says 65% of a win is better than 0%. I agree with you. Yeah, I agree with you. All right, let's take a look at a couple more. I'd like to get them into our portfolio so we can track them. Okay, we'll go through it a little bit quicker. Oh, good, just got filled on that. PLTR. Now you're going to go, Connie, you can use that stock a lot. Sometimes we do. We have our watch list. We created this a month ago. We'll probably update it next week. Okay. We created this a month ago, and these are stocks that we said we're willing to trade. They might go bullish. They might go bearish. Sometimes we might trade them bullish, and then they change and we trade them bearish. Okay. Something that's nice about having a fixed watch list is that you kind of get used to those stocks and what they typically do, right? It's not like brand new adventure every single trade. It's like, oh yeah, we did this, and this is, you know, how our last couple of trades went with this. Okay, doesn't mean they'll do the same thing they did before, but it kind of gives us a feel. Are they a more volatile stock? Are they a less volatile stock? And we had a trade in a different class right here where we got in the same day and out. Okay, it doesn't happen very often. That was in our option strategies class. Okay, but what have we got going on here? You guys seen any images of like maybe a flagpole? If I draw, I don't know if I like those two little guys there. Usually I like it. I kind of am a purist. I like it to really be pop, pop, pop. But we'll take it as a flag. And then what has it been doing here? Well, it was trying, I would say it was trying to break out of the flag pattern. And how I had drawn this earlier, it looked a little bit more convincing. So some people might say, don't get in yet. Make sure it really goes through this resistance at 125. So we can put on a conditional order. We could put on a conditional order, let's say if the stock gets to 127. Okay, 127. Let's come back here. 127 is we're going to make it conditional upon reaching that point. Okay, let's see what we have as far as strike prices go. Now in this one's kind of interesting. Can you see the implied volatility, how high it is here? Yeah, it's I'm going to say a decent amount that there's volatility in this stock. And because of that, the options might be a little bit more pricey. That means the premium we sell might be a little bit more juicy. It also could mean that we can back off our delta a little bit and still bring in the kind of return that we typically like to see. Okay, let's see if these strikes still look reasonable. I was looking at this 117. It right now has a 31 delta, and the 115. I like that these are $2 apart. And if we were to kind of jump up here to say 110, they're going to be in $5 increments for a little bit and then switch to 250. So $2 is kind of nice. We can kind of, I don't want to say cherry pick, but pick a little bit closer what we're really most interested in trading. Okay, so I was thinking 117, 115. So let's cue that up. We're going to sell that vertical. What kind of return is that going to give us? Ooh, 62 cents. That is juicy. Okay, if you like a juicy steak or a juicy peach, this is juicy. How juicy is it? Okay, let's go 2 minus 0.62. So 138 would be our maximum theoretical risk, right? That's more than what we have to gain here. But let's see what that return percentage might look like. So we'll take 62 and divide that by 1.38. It's about a 44, almost a 45% return. So when I say it's juicy, it is. It's kind of like juicy fruit gum. I don't know if they still have that anymore. But we're going to go with it. Okay. If you wanted to do higher probability, right, you could go out further. Like I said, then you start getting into 5-cent increments after you get up to that 115, then it goes to the 110. So it makes it a little bit harder to kind of massage in, your perfect trade that you'd love to have. Not that you're going to trade it perfectly or that it's going to be perfect for you, but just kind of what you have in mind is your ideal. Okay, 62%. How much can we risk? If we are risking, in this case, $138, let's take our 1,500, divide that by max theoretical loss of 138. We could do 10 contracts. Okay, we're going to do it. We are going to put on our 10 contracts. Would you have to put on 10? Absolutely no. If it was something you felt like, for whatever reason you have a concern, you don't have to put on the full amount. You could go 5 and say, no, I only want a half a position here. Maybe later I'd consider doing more contracts. Okay, let's create an opposite order here. What should we buy it back at? All right, we're going to do 65% because today is 65% day. And we're going to multiply that by 0.62. I did that incorrectly. Let me clear that out. We're going to go our 62 cents, but instead of multiplying it by 65%, we want to multiply it by 35% because that is what would be left after we capture the 65. All right, we're going to buy it back at 21 cents. And we're going to make this one a good till cancel as well. We're going to send that into our bullish bucket. All right, we're going to get one more in here before I'm out of time. This one's kind of interesting. Okay, those of you that trade maybe smaller accounts that kind of need to work with smaller stock dollars, you might find this one interesting. Now, this is one that's been coming up on my early morning movers scan. And I think it also came off our watch list. In any case, it's a newer stock that's been kind of newer on the horizon, okay, as far as taking off in the last several months and really kind of getting out of a low price dollar stock range. And so we can see around $9, had some really good support. It was really good resistance. Oh, look, it was acting as really good resistance again. They had their earnings, they popped up, they came back, they tested that support level. Looks like we're either getting in on a support bounce of that 10 moving average or just kind of the bottom of the gap. Many times the bottom of that gap acts as support. Look what it did. It's acting as support. Now, earnings is over, but because the stock is moving so much, the volatility is pretty high. Look at this one now. This is twice what Palantir was, right? 150, 152, 151. What does that mean? Really, really juicy premiums, okay? We're going to use the June 20s here, and we're going to go, I think we can still go quite a ways out of the money. I played with a lot of different strike prices here. Let's see if these still work. Look at this one. This 10 strike price is a 23 delta. We've got oodles of contracts out there, 1,241, whole bunch, few more today, a couple hundred more. A 23 usually is a pretty decent ways out of the money. And right now the probability is at 63, almost 64%, okay? We're gonna sell this vertical. We're going to spread it out, not by 50 cents. Oops. We get that in the right spot. We want that just to be a 9 even. We're going to have a $1 wide spread. We're going to bring in 32 cents. Okay, 32 divided by 68 is going to give us, I think, a 30-something percent. Let's divide that by 68, there we go. It's about a 47% return. Well, that's a healthy return for any stock. That's a healthy return. And it's already so far out of the money. You could experiment a little bit more, see if you, in your practice trading, because I encourage you to practice trade these in your own paper money account, see how it works, right? Try these out. Let's see, 68, if we have 5,800 divided by 68 is our max theoretical loss, 22 contracts, okay? Do we have enough open interest out here that we could be 22 of the contracts? We do. Now, if you've got a smaller account, one thing's nice about this is the single dollar increment, and maybe you could get into the trade doing 1 or 2 strikes or 1 or 2 contracts. I want this to be 22. All right, we're going to do a first trigger sequential. We're going to put on that opposite order. And let's go. 65% again, okay? So 35% is left of our 32 cents. We're going to buy it back at 11, okay? My secret desire doesn't mean that it'll happen, but I would love it if by the time we got back next week, I would love it if it went boom, 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 and ticked them all off. Right? That it locked in that max gain because we were a little bit more generous as far as how much we'd buy it back for. All right, we're going to put this in our bucket here as well. And if you have any questions that we haven't got to or haven't answered, chat them in right now. I am going to take a look at the chat, make sure there's nothing there that I need. Now, Nick, when you say, can I explain how you manage a short vertical if the price is near expiration and in between the strike prices? One, use the 4 to 10 days. Don't get close to expiration. Be like on the way out that it's not even a consideration. Okay, so that's one thing. 2, you might decide if you really don't want to take ownership of the stock or have that assigned to you, I should say. You could close the trade down, but if there's not a lot of time for it before it expires, it leaves you with less opportunities. If you've got a lot of time, sometimes depending on the stock, if the trend has changed on you, you might go buy back that short leg and let the long leg run. We've done some examples of that when our stocks have gotten in that situation. Okay, so there are some things that you can do. All right, you guys have been great today. Brand, thank you so much for helping out in our chat. we've got 6 trades I'm going to be watching like a hawk over the next week. Now, I'm going to encourage you to paper trade them in your own account as well. That's how you get better. That's how you'll learn. Okay, so take me up on that. Very good. Now, next up, we're going to have Getting Started with Stock Investing. Kevin Horner will, actually, Kevin's out today. I think Mike's going to be leading that class. I'll be in the chat to answer your questions. So appreciate you being here. Go get a drink, and we'll see you in about 15 minutes. See you later, guys.